TradeMark East Africa's programs are geared to reducing the barriers and the cost of business in the East African region. In this regard, ASSET is supporting the region's revenue authorities as well as the trade and transport fraternity to develop an alternative to transit bonds. The objective of the Alternative System for Secure Transit scheme is to provide an alternative for transit bonds, hence reducing the cost of doing business for traders and therefore releasing the estimated $1 billion tied up in transit bonds per day in the COMESA region. It will also eventually provide opportunities for the reduction of cost of goods, particularly in the landlocked countries. This is how. When a trader imports goods for transit, he is required to execute a bond in each country that the goods will pass through. This bond guarantees the transit country the collection of duties and taxes if for any reason the goods in transit remain in the country either by diversion or dumping. Here's a typical scenario. John is an importer of a standard 20-foot container whose customs, insurance and freight value is $100,000 at Mombasa. Kigali is the final destination of the goods. If the expected duties and taxes at the destination for the consignment are pegged at 25%, that's customs, excise and VAT, then he is expected to have $25,000 as payment for the duties on arrival in Rwanda as he clears his goods for home use. Because Rwanda is a landlocked country, his container is transported by ship to the port of Mombasa and then transported by track through Kenya, Uganda and finally Rwanda, passing border points at Malaba, which is at the border of Kenya and Uganda, and Gatuna, which is at the border of Uganda and Rwanda. Since the consignment is not for home use in Kenya and Uganda, the transit requires the execution of a bond to cover the duties and taxes that he may be required to pay if the goods go missing in that country. As a matter of fact, he is expected to have the consignment covered under a transit bond even while in Rwanda as long as the goods remain in transit and have not been cleared into home use or into a bonded warehouse or into any other customs regime other than transit. The bond may be a cash bond in the worst case scenario or a facility obtained at a bank or insurance company. It could be a facility held as a general or specific bond by John himself, or a facility that he uses for a fee that is held by a clearing agent as a general bond, which is obtained from an insurance company or bank for a fee secured by collateral. The clearing agent registers a bond account with the revenue authorities, and this account is debited and credited accordingly on commencement and completion of transit operations. Assume the clearing agent holds a $1 million bond at 15% interest from a bank with collateral worth $1 million covering it. That's money and collateral that is tied up that could have been used for something else. Let's assume the importer opts to use a bond held by a clearing agent and pays a fee for its use. The clearing agent allows him the use of the bond, and the importer declares which bond account will be used for the consignment on his transit declaration form. Typical fees range from 0.75% of the bond value and in John's case 0.7% of $25,000. The clearing agent's general bond is now reduced by $25,000 as this amount is used to cover the current consignment. This bond will be acquitted when the consignment reaches its destination. John also has to execute a similar bond in Uganda and for the transit portion of Rwanda before being given clearance by the revenue authorities for his consignment to move within their territories. The cost of the consignment to John so far is the CIF of the consignment on delivery up to the port, the cost of the use of the bond in Kenya, the cost of the use of the bond in Uganda, the cost of the use of the bond in Rwanda, and the duties and taxes due at the destination, and the additional cost of transport and logistics. Assume John has 5 such containers moving on the transit corridors at any given time. The costs are 5 times more than the outlined above, and if John diverts just 1 container of the consignment, the revenue authority in the countries the goods are dumped will call up the bond to seek payment. This is a big loss at many levels. All related costs of the entire bond on all 5 of John's containers will pile up until the case is resolved, and they will cause the clearing agent the loss of the use of part of his general bond, even though only one container is diverted. The clearing agent's insurance company has to pay for the claim by the revenue authority and seek reimbursement either through a collateral deposited with them or other means from their principal or importer. Often, the clearing agent is barred from doing other business with the revenue authorities, and bank accounts may be frozen until the resolution of such cases. Many times, due to poor record keeping, acquittal, and processing of these claims, it can take months. The risk on the loss of any part of the consignment against the revenue earned by the insurance company does not provide a positive cost benefit. The insurance company would rather not be in this business, but because they want their clearing agent's other insurance business, they offer this as a service to sweeten the deal. As John's consignment crosses borders, the portion of the bond covering that part of transit is supposed to be automatically acquitted, and indeed, in some revenue authorities, the system of acquittal is noted electronically. However, the reuse of the bonds in most countries require that proof is provided that the goods did indeed reach the destination country. Hence, once John's consignment is delivered to Rwanda, it then goes back to the Kenya Revenue Authority and the Uganda Revenue Authority with proof that it arrived in Rwanda and starts the acquittal process, which can take anywhere from 4 to 90 days. This process involves enormous amounts of paperwork, a lot of administrative costs, hours of queuing at various offices, and finally, a long wait as the bond payment is processed. The current bond system ties up a lot of finances in the region, which could have been used for other purposes. The system is not as efficient as it could be, causing delays which lead to additional costs on the logistics chain. By some estimates, the amount of money that is held up in bonds in the Comesa region exceeds $1 billion on any given day. The asset scheme is designed to provide an alternative system for transit bonds by providing better security of transit goods, hence securing the government revenue, while at the same time reducing the amount of money tied up in the region as transit bonds, as well as reducing the cost and effort of managing a bond scheme. Under asset, John's costs for the consignments are the CIF value to the Port of Mombasa, the cost of accessing the cash equivalent to pay for duties and taxes up front, or the opportunity cost of putting this cash up front for the number of days of transit, typically 15 to 21 days, and the transport and logistics cost. In the medium to long term, asset is cheaper for the importers than the national bond schemes. There is no need for clearing agents to hold large general bonds, and hence there is no need for collateral needed to hold such bonds. This therefore improves the borrowing capacity and leverage for the agents. The insurance companies lose the opportunity of an income stream in bonds, but regain reinsurance opportunities for asset. The banks benefit from the float of money in the asset system, and hence can afford to keep the cost of participating in the asset scheme lower than in the current national schemes. The revenue authorities benefit from greater security of transit, as the incentive for the importers to dump are usually duty and tax evasion, but in asset, this amount is secured up front. This provides the revenue authorities opportunities to provide incentives to the participating importers, for example, availing them a green lane facilities for faster clearance using the asset scheme as a criteria in authorized economic operator schemes. The overall result of asset is a much more efficient system to secure transit goods, which has less administration and operations cost. It has the added benefits of releasing huge amounts of finances into the region for other use, therefore providing the potential for improving competitiveness in the region through reduction of the cost of transport and logistics and the reduction of costs of doing business in the region. Eventually, it leads to the reduction of costs of goods in the landlocked countries.